Most Canadians think life insurance is just something that you buy to protect your family in case you pass away. But high-income professionals and business owners, it's way more than that. Life insurance can actually be used as a strategic financial tool to protect your wealth, reduce your taxes, and grow your money. My name is Laurent Munier. I'm an advisor and founder here at Safe Pacific, and we put together personalized financial plans to help Canadians like you keep more of your income, grow your wealth, and eventually pass it on using tools like life insurance. In today's video, we're going to walk you through exactly how life insurance works in Canada, the different types available, and how it can be used as a smart part of your long-term financial strategy. So let's start. What is life insurance and why does it matter in Canada? Life insurance in Canada is more than just a safety net. It's a strategic financial tool designed to protect your family, to preserve your wealth, and to create long-term financial stability. At its core, a life insurance policy is a legal contract between you and a Canadian life insurance company. You agree to pay the premiums, which are monthly or annually, and in return, they promise to pay out a tax-free death benefit to your beneficiaries when you pass away. So this death benefit is designed to support your loved ones during a difficult time, and it can help to cover funeral costs or replace income or pay outstanding debts like a mortgage or fund your children's education. It can maintain the family lifestyle. And a lot of our clients use it to pay taxes. In short, the insurance provides peace of mind, and then you can know that your family's financial future is protected even if the worst happens. But if you're a high-income earner, or you're incorporated, or you're an incorporated professional in Canada, life insurance does way more than just provide the payout after death, which it does, but there's more. The real advantage comes from using the right kind of life insurance. Particularly the one we're going to talk about is called participating whole life insurance. And then you can access powerful living benefits while you're still alive. These permanent life insurance policies can accumulate a cash value over time that grows tax deferred and is backed by the financial strength of that insurance company. So the cash value can become an asset, one that you can borrow against. You can leverage it for retirement income. You can use it to fund investments. You can buy other businesses. You can use it for business opportunities or your own growth. Many high net worth Canadians use this structure to complement their RRSPs, their TFSAs, their corporate holdings in a way that's low risk, tax efficient, and built for long-term growth. So at Safe Pacific, we show clients how life insurance can become a cornerstone of a conservative, high-efficiency financial strategy that offers protection, growth, and liquidity all in one. So whether your goal is to safeguard your family, or to reduce your tax burden, or to grow the wealth inside your corporation, or maybe to leave a legacy for the next generation, the life insurance can play a bigger role than most people realize. But really, to understand the role and how it fits inside your financial plan, you have to understand the different types of insurance. So the biggest one is just understanding term insurance versus permanent insurance in Canada. So if you're Canadian and you're looking to build your long-term financial security, you need to understand this difference between term insurance and permanent insurance. These are two types of coverages that serve different roles in a well-structured financial plan. And choosing the right one depends on your goals, it depends on your income, and it depends on your life stage, like where are you? So we'll start with term insurance. Term insurance in Canada provides protection for a set period of time. This is usually for a term for 10 years or 20 years or 30 years. And it's really designed to cover temporary financial obligations during your working years. So this would be things like paying off your mortgage, replacing your income while you're raising a family, covering debts or loans, making sure your children can afford to go to post-secondary school. And because it offers a straightforward death benefit, there's no investment component, there's no savings, term insurance is generally the most affordable option up front. If you pass away during the term, your beneficiaries receive a tax-free lump sum. If you outlive the term, the coverage expires, so there's no payout, there's no accumulated value or anything like that. Most term policies can be converted to permanent coverage later, which is useful for people who want to start with a lower premium now and then transition to more long-term planning as their income grows later. That's the basics on term insurance. So now what's permanent insurance? Permanent insurance, on the other hand, is really designed to provide lifelong coverage with additional financial benefits more than just the death benefit. So these policies remain in force for your entire life as long as you're paying the premiums. And they include what's called a cash value component that grows over time. And the growth inside that cash value component is tax deferred. So there's a few types of permanent insurance. The one that we use the most is called whole life insurance. It has a set premium. So the premium is going to be the same every month or every year. And it's got a guaranteed cash value that grows usually with a dividend. And you can set it up in different ways to make that grow bigger or slower or however you want to do it. When those whole life policies are participating, it includes dividends that are based on the performance of the insurance company's participating account. So your cash value grows through this dividend. Another one that you can have is called universal life. So this is more flexible. It allows a greater adjustment in kind of like your annual premium. You have a greater range between the minimum you have to put in and the maximum that you're allowed to put in. Universal life insurance, the people who like it, they like it more because you have more control over what it's invested in. Whereas whole life, the insurance company does that and you don't have any sort of control over what they do with the money. With universal life, you can buy all sorts of different types of funds. The reason we don't use universal life so much is just because it's more complicated. It takes more work on an annual basis. You need to keep up with it. You need to adjust the investments over time. And there's just a lot more moving parts that are a little bit more difficult to understand. So, when you receive your statement, it's harder to read. So some people like that, some people don't. Some of the benefits of universal life insurance is you can usually get the premium amounts to be significantly less than whole life amounts. Where it doesn't really work with the clients that we work with, because a lot of the clients that we work with are leveraging these policies with a bank. So the bank will give you less loan on a universal life policy than they will on a whole life policy, unless you convert the investment options in the universal life to things that are guaranteed. Then you can get higher, but then you defeat the purpose of having the universal life where you can choose your types of investments. You can have universal life, you can have whole life, pros and cons to each. We generally will default to the whole life. The other third type is what's called a term 100. So this is a term until your age is 100. So this is lifetime coverage, but there's no cash value. So this is just straight term insurance until your age 100. This is the purest way of knowing what's the cost of having insurance for the rest of your life. It's usually lower premiums than the other two, than the universal life and the whole life. There's pros and cons. So number one, it's stripped out. There's no bells and whistles on it. It's just straight term insurance for 100 years. It doesn't have the cash values. It doesn't have any sort of moving parts. Some people like it because the premiums are lower. And so generally people want to pay less for their insurance. Where the con is, because you don't build up the cash values, you can never offset the premium, right? So you have to pay the premium every month or every year for the rest of your life. And if you miss the premiums, you could cancel the insurance and then not have it. So this is fine now when you're 30 or 40 or 50 or 60 years old and everything is great and you're earning money and you want to pay these premiums and you're remembering to pay these premiums. But what if you are now 70 or 80 or 90 and you're not earning money, and now you see this as an expense that you're like, well, why am I even paying for this? Or maybe you don't pay those premiums later. So you've paid premiums for 30 years and then you miss a couple later. Well, that coverage is canceled. So it's not guaranteed that you're going to have it because, again, the insurance works. The error is usually user error. That's why we sometimes offer term 100, but sometimes don't, is just because we don't know what's going to happen in 20, 30, 40 years. Are you still going to be paying these premiums and are you going to get what you want? So our clients typically benefit the most from participating whole life insurance, especially when we're using these more advanced strategies like the immediate financing arrangement, infinite banking, using it for retirement income planning, which would be like an IRP, insured retirement plan. This type of policy, like a whole life policy, not only guarantees that tax-free death benefit like all the other ones do, but it builds that stable long-term cash value that you can access through your life through either policy loans or withdrawals or collateral loans without triggering immediate tax consequences. Also with the whole life policies, you can get them to a stage that's called offset. So there's enough cash value in the policy that it can pay the premiums for yourself so you don't have to put any more money in. So you could say, put my policy in offset. I'm not going to pay anything into this anymore. The policy is going to be self-sustaining for the rest of my life, and then I own it. You can also do paid up, which is a guaranteed way to pay for your insurance for a certain period of time and then keep it for the rest of your life. So which one is right for you? Well, I don't know. I don't know you. You're just watching videos here on YouTube, but you're going to choose term insurance if you're focused on short to medium term protection. So this would be things like income replacement, debt coverage during your peak earning years. You want to choose the permanent life insurance option, so the whole life, universal life. If you want to grow wealth tax efficiently, if you want to protect your estate, and if you want to create a legacy, especially if you're an incorporated business owner or you're a higher income professional. Actually, real estate investors, this is really big for real estate, especially somebody who's going to have big capital gains in the future, and they want the family not to have to sell the assets, but they need the money to pay the taxes that are going to happen in the future. So a good way to pay those taxes is to have insurance payout, and then you take the insurance money and you give it to the CRA and you say, I'm going to keep these 3 buildings or whatever it is that you want to keep in the family. All of these have their place. And most of our clients are actually using a combination of term and permanent, because we really will design this insurance plan to suit their situation, to suit their goals, and to suit where they are in life right now. And that's going to change over time. So how does life insurance work while you're still alive? And like, how do you get to understand these living benefits of the whole life insurance in Canada? Now, most Canadians think of life insurance as something that only pays out when you pass away. But the right type of life insurance actually can benefit you while you're alive. So you can grow and you can access these cash values in a very tax efficient way. It helps to build a financial safety net, and it offers the insurance protection that you need in the first place, right? So this is what participating whole life insurance does. So when you set up these policies, part of your premium goes to pay for the insurance, and part of it goes into a professionally managed investment pool. This is called the participating account. This is why it's called participating whole life account. So this participating account is maintained by the insurance company. So this would be Canada Life, Manulife, Sun Life, Equitable Life. They invest in a diversified mix of stable long-term assets. So long-term government bonds, this would be called fixed income. They have a ton of real estate, infrastructure projects. They have some equities and some private placements in it, but they're really buying long-term things so that they can build this money up over the long term, right? These policies are for the rest of your life. The returns from this participating account are distributed to the policyholders annually in the form of dividends, which are typically used to purchase what's called paid-up additions. So this is the way we set up these policies. So the paid-up additions can boost your death benefit, and then it'll boost your cash, and it'll boost your death benefit, and it'll boost your cash. And then here's where the power is. So over time, the policy accumulates this guaranteed tax-deferred cash value, and the cash value doesn't go up and down. It's not subject to market volatility. So even during economic downturns or a stock market crash, so unlike other registered investments like your RRSP or TFSA, the money inside the policy can be accessed without triggering the capital gains or taxes. So if you need money, you need liquidity, you can borrow against this cash value using policy loans, either directly from the insurance company or from a Canadian bank. If you're borrowing from a bank, it's called a collateral loan. So all the major Canadian banks do this: BMO, RBC, Manulife Bank, Scotiabank, CIBC. They use your policy as collateral, and then they'll give you flexible access to funds. So this could be for your retirement income. This could be for buying more properties. This could be for investing in your business or in a business. This could be for emergency expenses or opportunities. So because this borrowing, you do all of the underwriting up front. So you do your credit check, and the bank checks to see if they want to give you the money. You do that all up front. But then once it's done and you need to use the money, there's no more credit checks. There's no more income verification. So this is a really useful option for entrepreneurs. If you're self-employed, if you're a professional, it's really big for real estate investors that may want like alternatives to traditional financing. And then eventually, you're going to pass away. So this full death benefit, including any accumulated paid up additions, is paid out tax-free to either your corporation or to your beneficiaries. So this will bypass probate. It'll usually avoid the will if you do it right, and CRA is not involved. So this makes participating whole life insurance one of the most effective estate planning tools that's available in Canada. So really, it's not just insurance. It's a conservative, tax-efficient asset class that you can use during your life while also creating a guaranteed legacy for your family. So here's some real Canadian benefits of the life insurance and why it's a smart wealth strategy for business owners and professionals. So life insurance has evolved, far beyond being just a safety net for your loved ones. So today, life insurance is a powerful strategic financial tool that plays a vital role in wealth accumulation, in tax planning, and estate preservation, especially for incorporated professionals. Say you're a doctor, you're a dentist, you're a lawyer, an accountant, entrepreneur, software developer who's building serious wealth inside the corporation. So You've already maxed out your RRSP, you've already maxed out your TFSA, and you have retained earnings inside the corporation. The next question is, where do you grow your money safely, tax efficiently, and with your long-term legacy in mind, right? And this is where the whole life insurance comes in. When it's structured properly, the whole life policy offers a suite of benefits that few other financial vehicles in Canada can match. So number one, you get that tax sheltered growth inside the policy. So the cash value grows tax deferred, which means you don't pay annual taxes on the gains. This makes it an excellent place to accumulate wealth inside the corporation without triggering capital gains tax and without triggering their passive income taxes. And number two, you get the guaranteed access to your cash value. So over time, the policy is going to build a guaranteed stable cash value, and you can borrow against it tax-free using either policy loans from the insurance company or collateral loans from a bank. So this gives you liquidity for the business. So you're putting the money inside the policy, but you also have access to that money to use it for opportunities, for emergencies, for retirement, whatever, without impacting your credit, without having to sell other investments. A third is there's a tax-free death benefit. So life insurance in Canada pays out tax-free. When you pass away, this policy pays out the tax-free lump sum death benefit to either your corporation, if it's a corporately held policy, or to your beneficiaries directly, if it's a personal policy. If it's in a corporate policy, then it credits what's called a capital dividend account, a CDA. So you definitely want to talk to your accountant about CDA. They love it. A CDA is great. You should try to get as much as you can. And this allows a portion of that death benefit to flow from the corporation to your personal beneficiaries or to the corporate beneficiaries in a totally tax-free way. Another big advantage, number four, is there's no stock market risk. So the policy growth is not tied to this up and down volatility of the stock market. So any dividend growth inside the policy's cash values is immediately vested and guaranteed. So this means that your values will never go down once the cash hits the account. So this gives you predictable, steady compounding even during recessions or market crashes, which makes it a stable and conservative anchor for your portfolio. Another thing it lets you do is it lets you bypass probate and it skips legal disputes. So on a personal level, when it's set up correctly, life insurance should be set up to pay directly to your beneficiary. And it would typically bypass your will, and it would avoid probate. It would avoid legal delays, and it would avoid disputes over your estate. So this ensures a quick and smooth and efficient wealth transfer with less hassle for your family. In order to do this, you want to make sure that your beneficiaries are listed on the insurance policy. You don't want your insurance policy to have the estate as the beneficiary, because then it does go into the estate. It's tax-free to the estate, but then when it goes from the estate to whoever, it's not tax-free. So you're losing the point. So definitely have your beneficiaries named on your personal life insurance policies. And this goes for any type of life insurance policy. If it's a corporate policy, the corporation is going to be the beneficiary. So like I was saying, life insurance claims in Canada typically pay out within 2 weeks of receiving the death certificate. And I'm not talking like sometimes pay out, but like all of these insurance companies publish like how long it takes for checks to go out. And this is something that they actually track, and from a customer service perspective that they're really on top of. Most of these companies will pay out in like 7 to 10 days. I'm saying 2 weeks to give a benefit of the doubt and to extend it. But really, as soon as you send in a death certificate and the insurance company receives it, most of the time, like 95% of the time, you're getting a check within the next couple of weeks. So now, who benefits the most from these features? These two types of professions for sure. If you're a dentist or a doctor, you've got the high income, potentially an incorporated practice, and you've got a large future capital gain problem. Dentists and doctors, really, it's like a no-brainer for them to have these types of policies. And if you've heard about it, but you didn't really know how it works, reach out to us, go to the website, safepacific.com, fill out the form there, or book directly in our calendar. We're happy to meet and explain it. We work with a bunch of dentists, we work with a bunch of doctors, and we understand your situation. We've done this before, and we're happy to work with you. Lawyers and accountants as well, with retained earnings and long-term estate goals. So actually, lawyers as a profession is the highest number of clients that we have. Like the most of our clients are lawyers. So we work really well with lawyers. We work really well with accountants, and we can set these things up to really hit your goals, whether that's current goals, future goals, and then estate goals. And then entrepreneurs or business owners, they want to have this tax efficient access to the capital while still protecting their families and potential business partners. So business owners this makes a huge amount of sense because you're building up this pool of capital that can be liquid to do whatever you want. And you can build your business on it. But you also do need the protection. So you're getting the protection, but you also have access to all the money. So it's like you're paying for it, but you can still use it. And then real estate investors. This type of policy is huge for the right types of real estate investors who need a secure, liquid financing that doesn't correlate with the market. So when these things are structured correctly, the whole life insurance becomes more than just protection. It becomes a financial strategy. It grows with you. It supports your business and it protects your estate and helps you to leave a lasting legacy. And so for real estate investors, debt is such a massive part of how do you operate. And then this is one piece that you can add to your debt stack that has very favorable terms and that can be outside of your mortgages and that gives you a ton of flexibility and is quick. So once you have this thing set up, it takes some time to set it up, but once it's set up, your access to money is really fast so that you're able to take advantage of deals. So now, is this right for you? Well, here's why it might be essential if you're in this situation. So if you're a high earning professional, if you're an incorporated business owner, you're an entrepreneur, and you're growing the retained earnings inside your corporation, life insurance is obviously about the protection, but it's not just about protection. It's a critical part of a smart, tax efficient financial strategy. So whether you're looking to protect your loved ones, to preserve the estate, to build passive tax sheltered wealth, to access capital without triggering tax or without having to sell other assets, a properly structured whole life insurance policy can help you do all of that, and it can help you do more. So life insurance in Canada, especially these types of participating whole life policies, are uniquely positioned to solve these problems that traditional investment accounts like non-registered stock accounts, RRSPs, TFSAs, or corporate investments, they just can't do this, right? And then lastly, from an estate planning and legacy perspective, insurance provides a tax-free death benefit to the family or to your corporation or to your beneficiaries. So this ensures that your legacy is passed on smoothly, often outside of probate and often without CRA involvement, right? So it's one of the most efficient estate planning tools that's available for Canada. It's guaranteed, and it's especially important for those that have complex assets or who have like a complex organizational structure, multiple family members. Maybe you have a blended family. So you have, the ex-husband or the ex-wife with kids over there, and then you've got the new husband or new wife with kids over here. And having your estate pass through life insurance just makes things so much easier, quicker, and cheaper. And from a corporate tax efficiency perspective, if you're incorporated and you've got these retained earnings, putting these funds into a corporate-owned life insurance policy can help you to reduce your passive investment income. It can preserve your small business deduction, and it can shelter the growth from taxation. So when it's structured correctly, the death benefit can also flow through the capital dividend account, tax-free to the corporate beneficiaries. Another huge advantage is the liquidity without the liquidation. So unlike your RRSP or real estate or, these whole life policy can give you guaranteed access to liquidity through policy loans or through collateral loans without triggering capital gains, without dipping into your retirement fund, and without needing to sell investments. It might not be a good time to sell. Maybe the market's down and you need money. So you're going to sell something and lose money on it so that you can have the money. These policies give you that access to liquidity and to cash when you need it, especially in bad times. And if you're looking for long-term stability and growth, these participating whole life policies offer stable, conservative growth through the annual dividend and through the guaranteed cash value accumulation. So they're not tied to the market. They don't go up and down like the market. So it's a really reliable anchor for any sort of diversified financial plan. It's a great place to park your money. And so what do we do? Like, how does this all work with us? So we work with Canadian professionals. We work with Canadian business owners. We work with high income earners. And we design personal plans that use life insurance as a strategic tool to build and to keep your wealth. Right? And then what makes us stand out is really how do we operate and the depth of knowledge on the work that we do. So we analyze your corporate structure, we analyze your income level, we analyze your tax exposure, we look at your retirement and your estate planning goals, and we look at your full financial picture. So existing assets, existing liabilities, and then we stay in touch with you, right? So we customize the strategy that grows with you over time. And one thing that people really like is that we're totally independent. So we're not tied to one insurance company or one